All right, this is Corey here, back with Invest Like an Old Man. Hopefully, you all have watched part one of this video before you get into part two. Part one was telling you all about the things you need to do before you start investing in whether it's real estate, stocks, cryptocurrency, all about the stuff you need to do to put yourself in position. So if you've read that and listened to that video, then you're at the right place. This one is about sort of how do you get started with investing, and what should you buy. So the first thing I'll say is investing is not as complicated as people want to make it, right? So the first thing you got to do is you've got to get a brokerage account. People say, well, which brokerage company should I go with? It doesn't really matter. All of them are very similar. Some of them, have promotions that they give you when they sign up. Some of them offer some features that others don't. But if you're just getting into the game, it really doesn't matter. Many of them don't charge any commissions. Rather, people know about Robinhood, Webull, but even banks, many of them nowadays don't charge commissions to place trades. So I don't really have an opinion. I've used Wells Fargo, I've used Fidelity, I've used Charles Schwab. I've used all of them at some point. USAA over time. I have not noticed any significant difference between the different brokerages. So the first thing I'll tell you is, there isn't a big difference, in what you choose. So don't spend too much time on that. Once you get a brokerage account set up, the next step is really just to transfer some money over to that brokerage account, an amount of money that you feel comfortable losing, right? I'm saying that on purpose. I want to scare you. You can lose your money when you invest. Now, typically, will you lose all of it? No. If you have a good investment strategy over time, will you lose it? No. As a matter of fact, not only will you not lose it, you're probably going to make a lot of money if you continue to follow a strategy over time. How you can lose it? When you take these extreme risks, trying to get rich quick, FOMO, following what other people said, not doing your own research, those are the ways you're going to lose all of your money because you're not really investing at that point. That's gambling. And if you want to do that, just go to the casino. Sports betting is legal in a lot of states now. Just go to the sports betting app. If you want to gamble and double your money in a week, you're not really going to consistently do that in the stock market. It's going to be slow, steady returns, which is why I say invest like an old man. So now that you've got your brokerage account set up, what I recommend typically is just put your initial investment into an index fund, right? An index fund, there are a couple of them. There's the Total Stock Market Index Fund, the S&P 500 Index Fund, which is a popular one. It's the one that Warren Buffett recommends. This is simply a fund that tracks the stocks purchased by the index. So when people say the market is up or down, they're talking about the NASDAQ, the Dow Jones, the S&P 500. That's what they're talking about. And this is a collection of some of the biggest stocks that you've heard of. They're collected on these indexes. So they're not actively traded. What that means is if it's 500 stocks and I put my money into a fund, I'm going to own a percentage of all 500 of those stocks. If they go up, if they go down, my fund is going to go up or down based on what let's pretend like we're talking about the S&P 500. That's what I personally have. The S&P 500 goes up today, my index fund is going to go up. The fees are much lower in that because there isn't a fund manager that's in there trading, trying to actually beat the returns of the market. It's a passive fund and the funds are really low. And in that fund, typically you're going to average 9 to 10% over the last 80, 90 years, right? And it's not a lot of risk involved in that. You're not going to get rich overnight, but that's what I would typically recommend putting your money in the beginning, right? So if you don't want to do that and you want to take some more risk, you can try mutual funds, right? So mutual funds are similar to index funds, except the difference with the mutual fund is there's a fund manager who has an objective, and they're picking and choosing stocks to fit whatever their objective is, right? So they're trying to beat the returns of the market. So if the S&P 500 did 9% this year, they have a goal of doing better than 9%. That's the benchmark that they're compared to. So their goal is to beat that. So instead of them purchasing all 500 stocks or all 100 stocks in the Dow 100, they will try to pick the best ones. They won't buy some of the ones that they don't think are doing well, right? And sometimes they do better, sometimes they don't. Over time, most of these people do not beat the return of their benchmark. which is why I say just put your money in an index fund. Most of these people typically do not beat it, but it's possible, right? So they may buy just Walmart, Amazon, Apple, and they might not buy the company that you never heard of. Here's the problem with that. A lot of times your big returns, your huge returns, come from the companies that you've never heard of. Chances are Apple, Amazon, Walmart, Netflix is not going to jump 300% anytime soon. It's not going to go up 100% in a year. Usually, it may take some jumps if it went down the year before, but typically that's not where you get your large returns from. You get your large returns from these companies that are new, that are growing, that maybe beaten down, that people let the price get really low and someone found value in them. That's where you get your big jumps. And so one benefit of having the fund is if you have a good fund manager, they get those. One downside of that is if you have a fund manager that doesn't get it, you mix out on the big returns, which is why sometimes just putting your money in the index is better. Final thing I'll say is you can purchase individual stocks. This is extremely risky. You need to make sure you understand the risk that you're taking when you decide to go this route. I would recommend making sure you have the majority of your money in something less riskier, such as index funds or mutual funds or ETF, before you start purchasing individual stocks. Once you've done that, it's okay to go to individual stocks. So my next video, I'll talk about some of the things that you should consider when you decide you want to purchase individual stocks.